It is our weekly chat with Chris. I want to welcome everybody. We'll get some latecomers, but I like to start on time. That's a byproduct of my military training from the past. Today's chat, we're fortunate to have with us Mark Diorio. He is the Chief Investment Officer of Brookstone, and he's also a certified financial analyst. And for those of you that don't know what that means, in my experience, when I go to financial meetings, typically folks like Mark are some of the smartest people in the room. Now, he's very humble. He will sidestep that comment, but I am telling you, based on my experience of dealing with Brookstone CFAs in the past, and especially Mark, he's very down to earth, salt of the earth. One of the things I really like and appreciate about him is that he doesn't speak over your head. He helps you to understand what he's seeing and puts it in a context that's important. If you've not been on these calls before, typically our format, we've been doing this since COVID first broke out 2 years ago. And it's been a venue that has just picked up some traction. We take these calls, we record them, we post them so that you can follow up later. So if you know anybody else that should benefit from some of this content, I would, again, like to really thank Mark. Without further ado, Mark, welcome.
Great. And thanks for that intro, Chris. And thanks for everybody joining us. We have a pretty interesting topic that Chris put together, the ABCs of cryptocurrency. And I put this easy to read slide together just to give you an idea of a little bit of the history of cryptocurrency. That's a little tongue in cheek, but really what our role is to kind of decipher. There's a lot of news headlines, and a lot of it is eye-catching in terms of what is happening and what has happened over the years in cryptocurrency. So there's a lot going on, but our role is not to sell cryptocurrency in that sense. Our role is to really advise and cut through a lot of this noise to define what it is, what we see its role going forward, and does that impact you, and would it impact you in any given way. But on the next slide, we'll just define it real quick. So cryptocurrency in general is considered a medium of exchange. So that sounds like a typical US dollar, which is a fiat currency, is designed to be a medium of exchange, a unit of account, and a store of value. This is a little bit different. So I don't want you to think, because it has the currency name in there, it always gets attached to thinking of it like it's a currency of a country like the US or the euro or the Japanese yen. It's not like that. It's the currency of the network. And I'll explain a little bit what that means, but it's not kind of pegged to be used as a currency in the sense of everyday transactions. And that's one of the myths I think that's been out there, and I'll touch on that a bit too. So I wouldn't think of it in that sense. But overall, I'd point out that it's only in digital form. So it has no physical form. So if you see a picture of like a gold coin with a B in there, and it looks like it's a Bitcoin as a coin, that doesn't exist. It's only in digital format. And one of the benefits and one of the arguments that proponents of cryptocurrency make, in particular Bitcoin being the original one, is the supply of Bitcoin, unlike the supply of US dollars and any other traditional currencies, is not dictated basically by the central bank. The Federal Reserve is the central bank of the US. And so it's really dictated by the terms of the network, or in this case, the example we're going to use for sure is the largest, most well-known, which is Bitcoin, which tells you how many Bitcoin will be minted over what time period. And that adds to the value that some investors see in it. On the next slide, you have to think of cryptocurrency just like any other new technology. There's some benefits. In this case, increased transparency. You can track things. There's some cost reductions, just like what you would think in other technologies, but there's several unknowns as well. It's complex technology. The regulators don't know what to do with it, because you're transacting in currency format and making trades, and there's big moves up and down in valuations. So it's really kind of confusing how to wrap your arms around full-scale regulatory environment. But I do see that coming, and that's only going to be the benefit of both the technology, but also the users that may find use cases here. And I won't spend a lot of time on this slide because it's pretty easy to get lost. But if you follow along from the top left all the way around, the technology that supports cryptocurrency is broadly called blockchain technology. What it is if you send a message, or a computer system sends a message that they want to take one cryptocurrency and give it to somebody else. It sends a message to another computer system or network of computers that maintain the ledger. The ledger basically just says who has what. So Chris has 100 Bitcoin, let's say, and I have 200. Well, if he says he sends me 200, the system would automatically reject that and say, well, you only have 100. You couldn't sell 200 Bitcoin, as an example. And so you say, well, usually who would do that would be a bank, that intermediate third party who keeps the ledger. Now, what the technology has done is saying, we're going to keep the ledger amongst a variety of computer systems. Anyone, it's open source, can go and see this ledger and this transaction ledger. And so you validate that, and all the transactions that occur within a stated time period, let's say within 10 minutes for Bitcoin, for example, all those transactions get put together in a block, validated, and then put into the Bitcoin blockchain. And you just keep doing that every 10 minutes. And so there's a history, and that's why it's called a block, because you block all those transactions together and bolt them on to the last block. So the potential applications for blockchain technology, it doesn't necessarily have to be a cryptocurrency that you're transacting in. It can be used for automotive systems. You could track different changes to your vehicle, or updates or maintenance records. Financial services, the technology allows for cheaper transmissions. So sometimes you'll hear that, well, you can send money overseas much cheaper from your phone to someone else's phone using a cryptocurrency. You don't have to use Western Union or deal with some of the local authorities that are basically transacting or charging a lot in transaction fees. Voting, you can track that. Healthcare, you can track these records, and so everyone can access, or if given access, you can access these. So those are all the potentials for blockchain technology. I would say, though, that it's very important to realize that the technology behind blockchain, or the original reason for blockchain technology, was very specific. It was to create a cryptocurrency, or a digital unit of account that had some monetary value to it, that people could trade amongst themselves and provide those benefits and really adopt to the digital age. So previously, up to this point, you may say we've been in the information age, and that's where you have Google and other sources basically provide you all the information you need very quickly. And so they've done that very efficiently. Now we're looking at maybe the digitization age, is how do you make everything digital, and to speed up basically access to records. But it's creating something called crypto economics. And I don't hear about this, or this talked about all that much. And I think it's because it's a little complex, but all it is how are you incentivizing the users? So if you're to use Facebook and you spend an hour on Facebook and you post pictures, for example, well, what does Facebook do? Well, they sell your information to an advertiser. That advertiser pays Facebook. You don't benefit at all from that. Here, the idea is, well, maybe we have a way to incentivize the users of the network. So the owners of Facebook are shareholders. Here, the owners of the Bitcoin network are the Bitcoin owners, or those that own the cryptocurrency. And so what Bitcoin did as the original cryptocurrency was basically launch a Cambrian explosion of a variety of these projects, thinking that this was the next wave. And there's a lot of different use cases that could come about. So you see all these, there's been thousands issued, maybe the top 100. You may have heard of some of those that come into play. Ethereum is the second largest cryptocurrency, for example. And some of these on this list aren't even available today. But there's a number of different ones. And they're just different. Think of them as different stocks or companies. But instead of companies, they're networks. So they're just different individuals from different computer systems coming together for a reason to participate in that network for whatever it happens to be, whatever they're working on. So getting back to understanding Bitcoin as the first one, and to understand the entire cryptocurrency landscape, you have to understand Bitcoin by far. It's very unique. And so Bitcoin was created in 2008 by an anonymous cryptographer named Satoshi Nakamoto. Now, that's an alias. Nobody actually knows who he is to this day. He wrote a white paper, and it was titled Bitcoin Peer-to-Peer Electronic Cash. What he was trying to say is you take away any of the authorities, you take away the banking system, and now you have a unit that you can transact digitally from one to another. What he was solving was what's called in computer science, the Byzantine general's problem, which is how do you know that one digital item hasn't been spent multiple times? In other words, how do you validate that one of one? And that's what he worked on. The way he did that, how do you validate those transactions that I just mentioned in terms of how much does Chris have? How much does Mark have? Can they send what they're suggesting they can send? And do they actually own that amount? Well, it's called proof of work. So blockchain technology is called proof of work. And that's where a group of computers actually compete to try to validate that transaction that you just sent. So you send the transaction to the network, a group of computers actually competes to solve really what's a mathematical problem, but in some essence, a lottery, where every 10 minutes, and it's designed this from the Bitcoin software, every 10 minutes, they allow a miner to solve the problem and then validate that transaction. They're spending computer power to do that, and they're competing with other computer networks to do that. So they spend a lot of money on the energy that it takes to do that. And why they would do that is because they get mining rewards. Mining rewards are basically new Bitcoin, or the issuance of new Bitcoin. That's how Bitcoins are minted, or new ones are out into the system. And so that happens every 10 minutes, new Bitcoin are issued. And what I'll talk about in a moment is how they really drive value by issuing new Bitcoin and scarcity. But it's an open source, public, permissionless, immutable ledger.
Hey, Mark, before I go to the next slide, about 5 years ago, I had two separate clients, both of which one had read a lot about Bitcoin and went out and bought his own computers and set up his own mining. And one of the things that his comments when I talked to him was A, the cost for electricity, and B, the cooling that was necessary for the computer room that he had built. So that was one thing that he ran into. And then the other one was a young man that had his grandfather had passed away, and he gotten like $60,000 in an inheritance. And he had gone out and did a very similar function. Now, I haven't talked to him lately to see if he's been profitable, but I suspect he gave up or threw in the towel at some point in time. But my question is when they're competing, do you know, does buying state-of-the-art computer chips in speed give a miner a definitive advantage to somebody that might be saying, hey, I just want to set up my laptop and my computer in my office to run all the time 24/7, but I'm on, I'm still running DOS 3.0 from 20 years ago. So do you have any insight on that?
I do. So originally, when it first launched, because there wasn't that many people, that the cryptography kind of mailing list that got the white paper was very small, because they didn't really realize what this ultimately would become, because no one knew what it would become. But you could mine it on your computer, your home computer, with a CPU chip. Then as it got more competitive and it started to gain a little traction, then you had to go up to a GPU, which is a graphics chip, a gaming chip. And then now these are becoming mining farms, where it's a warehouse full of computers just running and running. And yes, one of the major companies that provides chips, NVIDIA, which is a major semiconductor maker, yes, is trying to produce the next generation type chips to help these miners. And miners do upgrade their equipment rather frequently to compete. And so there's big money into it now. So it's not something where you're in your garage and yes, okay, it's hot or it's running.
So we've elevated past the rubber bands and the shoestrings. I got it.
Yes, for sure.
Okay. All right. Well, thank you.
I did want to mention this slide because I think it's interesting, where you hear people talk about Bitcoin or cryptocurrency and act like this is hasn't been worked on, or there's no background to this. This was an issue and a project that's been worked on for 40 to 50 years, where you had computer scientists really work on this project and what Satoshi did, or the anonymous creator did, was very familiar with almost all of these and references different features of different white papers, or each one of these are different kind of projects that have been worked on, and they solved part of the issue and then part of the issue and then part of the issue. And Satoshi weaved it in really a profound way so that it worked essentially, and allowed a whole network to start building. All the way to the right, you see that Bitcoin was launched basically in 2009 began. So the white paper in 2008, the first transaction started in 2009, and then the system started to build literally from the ground up. So sometimes you may see those pictures of Bitcoin going from, zero all the way up to its current price and be profound. But you have to think about it in terms of, well, you could say that with a company where it had zero value and then all of a sudden it went up a significant amount. So sometimes that may be misleading. It's just more and more people started to get involved and enjoy it. At first, they were really hobbyists that liked this idea and what it was, and played around with it. And then going back to the technology as it developed, blockchain technology from 2009, it really developed not only to use as kind of a method to transact in cryptocurrencies, but you could, since it's a computer program, you could code it to include what are called smart contracts. In other words, you can code it in different manners and really make it whatever it is. And that goes back to the use cases. So it has some flexibility. And that's why you see so many different cryptocurrencies starting to be launched. But I would say they are different than Bitcoin. Bitcoin is very specific. It's the first one. It's almost like it's the reserve of all the others that have come after it. And I was mentioning one other piece, the mining rewards. Well, how much Bitcoin do you get issued as a miner, and how much is available every 10 minutes? Bitcoin was coded in such a way where there will only be 21 million Bitcoin ever produced. At the time of this, posted this chart, there was 18.5 million in that green line there, Bitcoin mined. So available out there, there's almost 19 million today. What it started with was 50 Bitcoin. So every 10 minutes, 50 Bitcoin would be minted. Well, it wasn't very much money in the early days, but every 4 years, the amount of Bitcoin and mining reward would be cut in half. So it went from 50 to 25 to 12.5, and then 6.25. So what that's done is really enforce this idea of scarcity. Less and less Bitcoin are being mined. And so for those proponents of Bitcoin and the value of Bitcoin, they're saying, well, it's the first digital, decentralized. That means the government doesn't control it. It's simply created. And then the marketplace, the users will determine its value based on market conditions, enthusiasm, availability, and other reasons why speculators might get involved, or just users of transferring money that want to use the network for different reasons. But the scarcity component really tells you that, oh, okay, there's not going to be just an unlimited amount. And that was one of the issues with a digital asset. You just keep producing an unlimited amount. So it would ultimately have pretty minimal value. Now, there are cryptocurrencies that do have an unlimited amount. A lot of them do. Something that was popular last year was something called Dogecoin or Doggy Coin that ran up. But that was a speculation kind of move in those marketplaces, but I don't think very well understood that Bitcoin is scarce. There's only 21 million. Dogecoin, they're just going to keep producing as many of those assets as they can, or those coins as they can. There is no cap, so there is no scarcity value. Another issue that pops up is that criminals use Bitcoin and it's a criminal network. Well, it's a public ledger, and you may hear every so often that the FBI or the government has found somebody that illicitly used cryptocurrency and they arrested them. That's because it's a public blockchain. Everything it's pseudonymous, not anonymous. And so everything can technically be tracked down if you're doing something illegal. And so the illegal use is far below that of cash. That might surprise people, but it's very minimal anymore. Originally, you may hear a story of something called the Silk Road, which was way back, this is circa 2012-ish, where they basically created a website and they sold some illicit or illegal things on there. It was kind of this trading route. It was just a website, but they did transact in Bitcoin. But it really wasn't Bitcoin being in the sense of what it is today, where now people know what it is, regulators know what it is, and it's a much bigger community that have been participating in Bitcoin. So this is one of those myths that are out that I don't think really rings true anymore to the ecosystem. Another one is payments. I was alluding to at the beginning where, oh, can you pay for your cup of coffee with Bitcoin or cryptocurrency? Well, one, if it's Bitcoin and it's scarce, you wouldn't want to transact in Bitcoin. The other reason is it's not a payment system. Visa, for example, is a payment system. They can transact, 24,000 transactions a second. Bitcoin can do about 7. It's not designed for those types of transactions. It's designed to be secure, move slowly. I call it a settlement network, meaning if you're moving larger sums or want to move those sums, it's not a payment network where you're doing your everyday transaction. So it'd be pretty foolish. And in the US, it's not considered a currency, so that'd be a taxable transaction. Anyway, you'd have to record it, act like you sold it if you bought something with it. So that's not very well understood, but you'll hear that probably for years in the media of, well, can I pay or buy something with it? We think of this as an emerging asset class. It's very early on. It is different than equities, bonds. Crypto assets are a different category, and within crypto assets, there are different types of cryptocurrencies, but Bitcoin, understanding that one is important to understanding the rest of the ecosystem. So where equities you have, well, there's corporate profits, economic growth, interest rates, productivity goes into those, bonds, economic growth, of course, interest rates, issuance. So they're really financial instruments. Crypto assets are based on investor adoption. Does the network grow over time, meaning more users? How are regulators going to look at this? And will institutions start to participate in that asset class overall? A good way to look at Bitcoin, I think, is, as opposed to looking at it as a currency like the US dollar, compare it to gold, where from a scarcity perspective, why is gold attractive? It's scarce, it's recognizable. Bitcoin's supply is fixed. We know there's going to be 21 million. We know the schedule that it'll be produced. Gold is scarce, but we can get more of it if mining picks up. If prices go higher, usually they'll start to try to mine more. Where Bitcoin, that doesn't work. And that's why you have some of these kind of boom bust cycles, because if the price is going up, you just don't find more Bitcoin. And so you have these boom bust type of cycles. And so it's software for Bitcoin, hardware, of course, for gold, portability. Bitcoin, you store it in your phone digitally. Gold, it's very hard to move around. It's heavy. Divisibility. Bitcoin can be divisible into basically the 9th decimal place, I believe it is. And so you can go very, very thin. In other words, you don't have to buy one full Bitcoin, which today trades around 28,000. You can buy fractions of that, $25 worth, for example, $30 worth, $100 worth. You'll just get fractions in Bitcoin. A storage digital wallet, very easy for Bitcoin. With gold, it's safer vault. Counterfeit, very difficult. Gold's now about $11 trillion market. Bitcoin's closer to about 800 billion. So there's a big difference. And some of the proponents would say, well, Bitcoin could catch gold. It has some of the same properties where it goes up and down, but it's a very similar type of vehicle, except one's digital and the other obviously is gold. This is the rub with Bitcoin, and from an investor's perspective, understanding the volatility of Bitcoin. Even though Bitcoin has grown over the last 10 years, it is as volatile as ever, as it ever has been. If you look at a drawdown of 50%, that rarely happens in the S&P 500, 4% of the time, basically, since 1900 has it done that. It's just a few occasions, and that's a major, major decline. With Bitcoin, 50% of its existence, it has had a 50% decline. In other words, if you own Bitcoin, you need to expect a 50% decline. And that's a lot different. And in fact, we've just gone through a more than 50% decline from just a few months ago. And so this happens pretty frequently to Bitcoin. The volatility level in Bitcoin is dramatic, and even a 70% decline, almost a quarter of the time, or 1/5 of the time, it experiences that. So it's at a pretty frequent clip that this volatility may not be appropriate for everybody. But it's okay to take a look if you have interest in it and how to get access to it. But this is hey, it doesn't make sense as an investment. For me, you have to go on, I think, expecting that 50% drawdown, maybe a 4-year holding period before you even evaluate it, because that market just moves around a lot. And I don't think that's changing anytime soon. Even as that network, if that network grows like it has been, that volatility will remain.
So before we go, because I see Fidelity there and we're at the hour, so I want to keep, for those that have to bounce, feel free to reach out. But because Fidelity's there, I heard last week on the news that Fidelity has just announced that, for folks that want to invest within their 401k, that now cryptocurrency will now be available. And a couple thoughts come across my mind, and volatility being one of them, because, with great reward comes great risk. And this chart sort of identifies that. So you have a couple things going on. People are hearing about it. Now their corporate plans may offer it, right? So if the plan sponsor allows it, they're able to step into an index and invest in it. What's your take on taxation? And, so let's just say you dollar cost average into an asset that does just, Peter Thiel, perfect example, that put all that money into a Roth, and, it's just all tax free, and the government looks at that and frowns upon that. So if you could speak to that briefly, that would be insightful.
Yeah, if you're looking for a long-term asset like this that has the potential to grow, and with the level of volatility, you think of it as position sizing, which means, okay, it's a small allocation. And then if it has that upside potential, what Peter Thiel did was he put it in a tax deferred account, essentially, and in a Roth even better, where you're not getting taxed on those withdrawals. But in the 401k, that makes sense to put it away and just think of it as long-term money. I mentioned 4 years. That would be kind of the minimum hold. So in other words, if you're thinking you're coming in and just doing a short-term trade, I don't know if that's worth it because of the volatility. You'll get swung around there. You could be very smart for 3 weeks and then look foolish for the next 4 weeks. And the numbers will be big. They won't be small. And that's why I'd say, yeah, it makes sense if you're putting it away, if you like it. And you don't have to. It's not where Bitcoin's displacing the US dollar. What it will do is give access to people that may have a cell phone in another country, in a third world country that doesn't have a strong currency. It may give them access to get Bitcoin and then convert to the US dollar when they're transacting in business. And that's something that I think actually opens up a lot of possibilities for maybe those in the emerging markets and the economy to get access to US dollars. And so it'll be an interesting, so I don't see the US dollar competing or Bitcoin competing with each other. I think they actually would complement each other in that sense.
Well, Mark, I want to thank you. These are our disclosures. Compliance makes us put all this fun reading in. Everything that we've talked about here is just educational in nature. Professional planning services. We're here to advise, but everything has to be risk appropriate. This was not a solicitation for anybody to go out and start buying crypto. But do your homework. If you have questions, reach out to us. There's a specific crypto that compliance made us put on, right? So if just for in the spirit of recordings, we'll leave that up there. And then lastly, if you have questions, folks, here's my email. Here's our phone number. I want to thank Mark, really, from the bottom of my heart. Appreciate you. I know you're really busy. You're running wild. The markets are cycling. You are the Chief Investment Officer of Brookstone, so you have a full plate. For you to take time out of your day to help me out goes a long way. So thank you very much. Tell everybody at Brookstone we said hello. And again, I really do want to thank you. This was very educational and insightful. Thank you, sir.
Great. Thanks, Chris.
Have a great day.
You too.
Bye-bye.
Bye.